Collection House calls in the administrators. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee because Collection House, a debt collector, has called in the administrators. And here the question from at least Business News Australia is, was the vault collapse the spark? Now, if you go back to 2019, we discussed Collection House on the channel. Collection House brushes off debt concerns after a bankruptcy spike. And I'll link to this video below, or you can find it on the channel, guys. Now, let's have a look, because they're a big player in this field. So, a recapitalization plan has failed to save debt collector Collection House after it languished for 2 years in COVID-induced doldrums and a weak national economic situation, with the company today announcing it has appointed administrators. Now, you'd think, with the fact that we have a construction apocalypse going on at the moment, we'd be hearing about, well, debt collectors would be good companies to invest in. Well, I guess not. Maybe they can't get the debts or the payments, and that's why these businesses are all going under. It's the liquidators or the administrators that we need to be investing in. So, what's the listed accounting practice, guys? Let me know in the comments below. We'll check it out. The Brisbane-based company today requested its securities be suspended from trading on the ASX and has appointed FTI Consulting as voluntary administrator, who now have the ironic task of protecting Collection House from creditors chasing up debts of their own. Oh boy, there you go. CLH said the decision came after exhaustive attempts to restructure the business and raise additional funding was successful. This included multiple divestments of assets, including its debt ledger book to Credit Corp Group. However, it was the company's debt facility, with now collapsed Vault Bank, secured against CLH's substantial investment in the neobank, which may have been its undoing after the challenger bank announced yesterday it was returning its banking license and asking users to withdraw all funds. Collection House made an investment of $8.5 million in Vault in January 2019, one day after the neobank had been given its authorized deposit-taking institutional license. By mid-2020, the value of the investment had declined to $4.86 million, dropping further to $3.5 by mid-2021. Voluntary administrators John Park, Ben Campbell, and Kelly Trenfield will now conduct an independent assessment of the business, engaging with key stakeholders regarding funding options, and run an expedited sale and recapitalization process for the company. Our intention is to undertake an urgent process seeking options to restructure and recapitalize the Collection House business, Park said. The voluntary administration comes after the company struggled to regain momentum following the COVID-19 pandemic and the impact it had on the national economy. Lingering effects of the health crisis meant general levels of activity in the debt collection sector remained depressed, according to CLH's latest half-year report, which described the company's performance as disappointing, with little improvement from the previous 6 months. General levels of activity in the receivables management sector over the last 6 months remained depressed as customers continued to implement conservative customer engagement strategies in response to the longer than anticipated COVID-19 impacts, with revenue remaining significantly lower than pre-COVID levels, CLH said in February this year. The half-year report was a harbinger of things to come for CLH, which saw its loss worsen significantly by 570.3% to $63.7 million, compared to a $9.5 million loss in the prior corresponding half-year period. Revenue was also weak in the 6 months to the 31st of December 2021, down 42.7% from $46.2 million to just $24.4. Two attempts to recapitalize and resuscitate the business appear to have been somewhat futile too. Over the past 2 years, more than $170 million of sales to Credit Corp Group have been completed, the later of which brought CLH's cash reserves to $9 million. The first recapitalization attempt was completed in December 2020, when it sold most of its $200 to $200 million purchased debt ledger book to Credit Corp Group for $160 million, plus a potential addition of $15 million depending on asset performance over the following 8 years. 1 month later, CLH CEO Doug McAlpine told shareholders at the 2020 annual general meeting that the sale would at least for now impact earnings and cash flow, and noted the next few account periods are likely to remain challenging. That was certainly the case. Following the AGM, the company's revenue continued to soften, down 46.6% to $46.2 million in the first half of 21. The losses improved at the time by 79.8% to $9.55 million. In April 2021, the company said flooding events in New South Wales, combined with the ongoing impacts of COVID-19, meant trading was subdued. Despite the circumstances, cash flow was positive in the March 2021 quarter. 2 months later, the company appointed a new CFO, Peter Gunn, replacing Linda Morris, who joined in January 2020, just 2 months before the virus outbreak hit Australia in earnest. The company appeared to be on the mend by the end of 2021 financial year. However, with losses improving significantly from a mid-pandemic loss after tax of $145.1 million to just $32 million. In the months since, however, the company's fortunes certainly took a turn, with CLH's latest first half results demonstrating a loss of $63.7 million, basically double the loss that it incurred in the entire prior financial year. This led CLH to throw one last-ditch Hail Mary that began its second recapitalization transaction. Under this deal, CLH hoped to become substantially debt-free, providing it with a pathway to return the business to profitability in line with the business turnaround initiatives. The transaction involved the sale of its New Zealand purchase debt ledger to Credit Corp for $12 million, and CLH agreed to let Credit Corp buy its outstanding senior debt, approximately $52 million, from existing lenders. Although the recapitalization results in an immediate improvement to CLH's balance sheet, the company continues to focus on revenue and productivity improvements in order to return the business to sustainable profit as a matter of priority, they said. It sounds like they should have just cut their losses, doesn't it? It sounds like this was just one failed attempt after another to keep it going. Our expectation of underlying recovery in the debt collection sector will assist in this recovery. However, the company is also implementing a range of strategies to reduce its overhead cost structure across premises, technology, and corporate costs. The board and management are confident that the repositioning of the company to a capital-light, customer-focused operating model provides a platform to better service our customers, clients, and communities. Recently, the company announced the completion of the sale to Credit Corp Group, noting it was released from all obligations associated with $52.2 million in senior debt. At the time, the company said it had a remaining $6 million senior debt facility secured on a limited resource basis against the company's investment in Volt Bank, an Australian neobank which has collapsed. $1 million of this Volt facility was repaid during March 2022, with the outstanding balance now $5 million, CLH said. They continue to actively explore law opportunities to realize this investment and expect to repay this remaining facility in the future. While today's announcement did not make the mention of the impact of Volt's collapse, the bank's closure can hardly have helped CLH, which is already in a serious predicament of its own. Business News Australia reached out to Collection House for clarification on the impact of the Volt collapse, but did not receive a response at the time of publication. So there we have it, everyone. Collection House, this just sounds like a complete and utter mess, really, doesn't it? Trying to keep it going. Let's have a bit of a talk about this. I don't think too many people will be disappointed that Collection House is coming to an end. But we'll have to keep an eye on the broader economy. This is just another business that has, suffered. Well, we'll say they were already in trouble, but it was exacerbated by the pandemic, the interventions that resulted with that, and, now the continuing issues in the wider economy. Anyway, guys, let me know your thoughts and opinions on this one. Thank you all for watching. Like, share, and subscribe to the channel. If you're a fan and enjoy the content I find and discuss here, there are a few ways you can help out. You can join us on YouTube or Patreon, use our referral links, buy our merch, or call us if you need an architect. Take care, guys. Have a great day. I'll see you all in the next episode of HeiseSays.